Imagine a row of dominoes perfectly lined up. If just one falls, it can knock over the entire sequence. Our global financial system can sometimes feel a bit like that, where the failure of one part could potentially trigger a wider collapse. So, how do economists and policymakers work to prevent such a systemic chain reaction? Well, the answer lies in something called macroprudential policies. These are targeted measures specifically designed to maintain the stability of the financial system as a whole, focusing on preventing widespread disruptions and protecting the broader economy from financial shocks. They aim to make the entire financial system more resilient, not just its individual components. The need for these policies became starkly clear after past financial crises, particularly the global financial crisis of 2008. Traditional regulation, known as macroprudential policy, primarily focuses on the safety and soundness of individual financial institutions, ensuring that each bank or insurer is solvent on its own. However, even if every individual institution is well managed, their collective actions can still create systemic risks. For example, during economic booms, banks might all lend aggressively, fueling asset bubbles. If those bubbles burst, the interconnectedness of the system means that problems at one institution can quickly spread, creating a domino effect across markets and countries. Macroprudential policies address this by looking at the big picture, monitoring system-wide risks like excessive credit growth, maturity mismatches, or interconnectedness between institutions. They aim to lean against the wind of financial cycles, building up buffers when times are good so they can be drawn down when times get tough. Regulators implement macroprudential policies through various tools. One key example is the countercyclical capital buffer, or CCYB. This tool requires banks to hold more capital during periods of rapid credit growth, building up a protective cushion. When the economy faces a downturn, this buffer can be released, allowing banks to absorb losses without cutting back lending too severely. Another tool involves setting limits on loan-to-value ratios for mortgages, which means a borrower can only finance a certain percentage of a property's value. This helps prevent excessive household debt and reduces the risk of property market bubbles. Similarly, debt-to-income ratios can cap how much individuals can borrow relative to their earnings, further curbing the buildup of unsustainable debt. These tools act as circuit breakers, slowing down the buildup of risks before they become critical. What is truly fascinating about macroprudential policies is their distinct role alongside other economic tools. They complement monetary policy, which typically focuses on price stability and inflation, and fiscal policy, which manages government spending and taxation. Macroprudential policies provide a specific layer of defense against financial instability, aiming to keep the financial plumbing sound so that other policies can operate effectively. They representing a crucial evolution in economic thought, recognizing that a stable financial system is not merely the sum of stable individual institutions, but requires active management of systemic risks. This integrated approach helps create a more robust economic environment. Ultimately, understanding macroprudential policies is about appreciating how policymakers work to safeguard the broader economy from financial turbulence. By proactively managing systemic risks through tools like capital buffers and lending limits, these policies aim to prevent the kind of financial crises that can derail growth, cause widespread job losses, and undermine public trust. They are a vital part of building a more resilient financial future, ensuring that the financial system serves as a stable foundation for prosperity, rather than a source of instability.